Today we're playing Tesla through a new fund that a lot of my subscribers brought to me called TSLY. See, we earn about 100,000 in income per year, and we're always looking to add to that in creative ways. And so TSLY is a way to play Tesla with covered calls. So TSLY 1725, it has a 65% dividend yield. 65%. So on a 1 year chart, it's been moving up with Tesla, and it's only been out for about a month or two. So Tesla has had a run, and so therefore this stock is having its run with it. However, it won't move exactly like Tesla as it sells covered calls, so it caps a lot of the upside. Let's look at Tesla first and see how that chart has been performing, and then let's compare it back to TSLY. See, on a 1 year, they look almost identical. Tesla was at 300, now it's at 200, so it has 50% upside, and it just had a positive report. Whether you want to look at the Tesla report this weekend as positive or negative on their deliveries, it doesn't matter. It fits the S&P. It's in the S&P, so it fits my target of having growth in the portfolio. Targeted growth, but with income. So I don't care what Tesla's doing. I don't care what Apple's doing or what Berkshire or any of these other guys are doing that are actually going to be other features of this fund who sell covered calls. This is a title fund, TIDAL title. They're going to have a couple of other funds, OARC. Some other readers recommended to me that they're going to have Apple and some others. Well, I don't really care what's happening with Apple or these other names because they're in the S&P, they're in the Nasdaq, they're benchmarked. And I have to have those benchmarks as a way to get performance in my own portfolio. So I don't care what the companies are doing. If they're going down, that's great. I'm going to buy more just to add more allocation and keep my weightings intact so that I can keep full exposure on to the S&P and Nasdaq the way that I want. And if they have dividends, well, it's just going to offset the losses, to the downside for these volatile funds. So they're very volatile, Tesla and some of these others, but the dividends will offset that. If the yield is 65% for TSLY, then that means that the stock has, however much downside you want, and that dividend is covering it. Okay, 65%, it covers 65% downside, which I don't think is going to happen in these funds. Also, this dividend's not going to stay this way. Obviously, if the stocks stay sideways for a while, volatility will remain muted, so the premiums would go down and dry up, and so this yield would go down. But if Tesla is going sideways and it's not doing much for your growth, because Tesla doesn't pay a dividend anyway. So if it's going sideways, well, you don't really want to be in Tesla. It just takes up margin debt. It's not paying you a dividend. It's not really giving you any benefit if it's going sideways or even down. But this fund will shield the downside, and while going sideways will still pay you income. It just won't give you as much upside participation. So if Tesla goes to 300, this stock probably will not go to 300. It will probably go to somewhere around 20. As you can see here, 20 on the chart is, if you just look at these old highs, 22. Is probably where 300 is on Tesla. So look at 22 on this chart from the beginning of 2023. 22, right, on TSLY. Look at Tesla. And I am spitballing here, guys. You guys brought this to me, so I'm just going by my own experience from prior trading. Okay, I have no idea how this is going to act. So look here on Tesla at the beginning of 2022. It was up here at 300, and that corresponds with about 22 on TSLY. TSLY corresponds with about 22 here. So see that? You could say 20 or even 22. So I would say the upside on TSLY is from 20 to 22. So 1725. Let's just do the math on that. 1725 to 20 is 16%, and to 22 you have 27%. So if we go from 200 to 300 on Tesla, that's a 50% gain, and you will only make about 30%, 20 to 30%. Let's go back to 20 and see what that was. You'll make about 15 to 30%. Now, if you add that dividend back in, which is 65% plus the 15, you're getting about 80% there. So you're not getting the full 50% if we go back from 200 to 300 in Tesla, but you're getting almost all of that. You're getting about 80%. So if we make it back to 22, you would see 30% plus 65, you would see almost that entire, you would see, if you go from 20 to 200 to 300, that's 50%. But here, 17 to 22, that's 30%, plus the dividend of 65, that's 95%. So you could potentially outperform Tesla here if I'm doing this math properly. You guys tell me if I'm doing it right or wrong. So, but that's the way I'm seeing it, is that you have some stock participation in the upside in this. You have about 15 to 30% upside if Tesla were to make it back to its old highs. And the options premiums would stay juicy because as the stock moves up, the options get pricier. Now, you don't want it to go too much higher because then they'll call away those options and it'll cap that price. So let's go to TSLY's website because I want to get some more information on that. So TSLY, we look here and we see that it has call options, and the strike prices for these calls are, I believe I saw here 210 for one call option and 222. So if we hit 210 on Tesla, I guess some shares would get called away. So that would cap some of your upside right there. Also, if we hit 210 or 222, which is not far away, we're talking maybe 5 or 10% away or less even. So some of those calls would get called away. That would cap the upside to this, but you would potentially still be making the higher premium since the stock is moving up, the premiums are moving up. You're just going to get called away, which caps the movement, which is like a lot of our other covered call funds. Like when we just did BlackRock, BDJ, as a safe way to play market recovery. See that last video. It is a covered call index as well, so it caps a lot of the upside. It'll still move up with the market, but it caps the upside because things get called away as they move past those strike prices. I'm assuming that's why. I don't know exactly how covered call options work. I know how when I sell covered calls, how they work, and when I sell a call and we get to that strike price, how I get called away. So that literally caps my upside. So I'm not sure how these other funds would do it. I'm sure it's just a better version of the way I do it. So also I wanted to show you some things that they also hold treasuries, 45% treasuries it looks like. So it keeps a safe cushion of income coming from treasuries. And if they hold that to maturity, that shouldn't be a problem, as you know. Silicon Valley Bank, that was an outlier. You sell these before maturity when they're fluctuating wildly in the marketplace. That could lead to some losses, but I assume that I'm going to call this TSLY, not Tesla. I'm going to assume TSLY doesn't have this kind of problem. They'll be able to hold these till maturity. So they're getting some cushion, stability, and extra income from these treasuries, but they have these call options at 210 and 222. So look out for those strike prices because that's where the yield might fluctuate. Maybe the yield will stay the same, but the price of the stock might fluctuate and maybe stay sideways and capped at around 20 or 22. So that's the way I'm looking at this. The NAV is 17.7, which means that and its expense ratio is only 1%. So out of the whole 65%, it's really negligible, the expense ratio you're seeing there. I want to show you the orders. We have orders ready to go. I'm buying 1,000 of each fund, OARC and Tesla. We're going to do OARC tomorrow, but here are my trading orders. The market just opened, so SMHB I'm buying, Whirlpool, USOI, SPG, TSLY just executed. I'm assuming TSLY and OARC. So let's go down here and check it out. TSLY, where is it? As we get into our new portfolio, so there it is. TSLY, okay, $1,000, and OARC, we have $1,000, and I'm actually glad that they're down a little bit today, so I can get a chance to add more to these there. But anyway, back to the subject at hand. So let's go check our estimated income out. And estimated income is now 103. So it's jumped considerably because of these purchases. And let's look at performance and value as we end here. Because the market's up 1,600 today. What does that mean? It doesn't mean anything unless we look at percentages. 0.25. What's the market up or down today? Dow's up 0.34, Nasdaq's down 0.6, S&P is down 0.110. So we're beating that market today. But anyway, performance and value on a long-term basis is 15.8%. Nasdaq at 16, S&P at 7, Dow's at 0.3. Also wanted to show you something that I found interesting. In a 1-year time period, it looks like I got creamed because last year was a tough year for the market, 2022. But just to show you that this strategy works, look at a 2-year chart of how I'm doing. I'm in line with all the indices, as you can see above. And then look at a 3-year chart. I'm up 200% versus all the indexes. I was up 300% at one point here, as you see there. So this strategy of taking income along with capital gains in the market, which are days gains, $1,600, when you take these capital gains along with dividends, you can really outperform the market. Now we're up 1,800, doesn't matter, that's a small amount. It's about percentages, 0.28. We're just trying to match the indexes. As long as you can match the indexes, you're going to come out ahead because the indexes average 7% a year. So we're beating the market handily with this strategy. Plus we use margins. So 303 is the other reason why I'm outperforming the market, obviously, because I'm doing twice the earnings of what my regular portfolio does. But if I'm owning all of these things in margin, but they're index tied or dividend tied like TSLY is, then the dividends pay back the margin over time. So I have all these puts on for insurance. I told you, when I put on all the puts, they always lose. So, but that's okay. I'm losing a small amount compared to the gains that we're getting. Anyway, so TSLY, very fascinating company. I'm so glad that I started this channel so that I could have people connect with me and I learn from other people and we all exchange ideas. So, let me know your thoughts on TSLY. We're doing the next video on ARK funds, OARK. I will look to add to TSLY at any time on a dip because Tesla is a strong growth name. I want Tesla. I've always wanted Tesla. I had Tesla in the form of sold puts, if you remember my past videos. We made about $900 on that play for doing nothing. We sold the put. It was at 100. The Tesla reached around 100. We sold the put at 50. So it was like zero risk, but we still got $900 in premium. So I was a fan of playing Tesla through selling options. I always wanted to sell calls on Tesla and Amazon and all these guys, but the assignment price was too high. I didn't want to get assigned to anything at high share prices, and that takes away all my margin equity. So I just want to show you one last thing. TSLY, its maintenance is 50%. That's what I love, 50%. I was so surprised that a stock this new, a fund that's this new and kind of, you could say, risky with the growth aspects of it, how it only traded, it was only a 50% maintenance, which most of these guys are 100% when they're new and don't have much of a track record. Same for OARK. So remember that for tomorrow as I do the video on OARK tomorrow. Anyway, that should do it for the video today. Again, let me know your thoughts in the comment section below. Take care.